Thank you for making tonight's event a priority and for participating in our discussion on the road to net zero. This event is part of the Integrated Management Symposium series. Many of you know that the school is named after Marcel Desautels, and he is the benefactor of this series and of, in some ways, tonight's event, which kicks off the 6th annual McGill International Portfolio Challenge. Most of you refer to this as MIPC. MIPC, and I'm saying this not just with pride, I'm saying this with empirical validation. We are the world's premier, in many ways, student-led challenge on portfolio construction and institutional investing. And I will give credit not to me, but to Professor Betermier, whose research focuses on pension funds, retirement systems, and sustainability. It's an incredible opportunity for students, professors, and industry professionals to come together, learn about and debate the future of sustainable finance. Events this week bring together about 100 students from 25 finalist teams from around the world to compete for $50,000 in cash prizes. That's remarkable. In total, 96 teams from 21 countries and 6 continents participated in this year's challenge. To all of you students, you are tomorrow's leaders. You are the ones, even more so than I, who will shape the future of this industry, and our future collectively, globally.
All right, so the agenda for today will go into 4 parts. The first is, let's have a bit of a progress update on net zero. Then we'll talk about the banks, the role of banks, public and private, in leading in participating in the transition. Then we'll talk about how to design effective carbon reduction targets for employers, for large investment managers, and then we'll talk about meeting the targets and getting your insights all along the way. Okay, so first, let's provide a little bit of context. The first one is what I find to be a fascinating chart that links the cumulative stock of carbon emissions in the air with the level of temperature increase relative to pre-industrial levels. Okay, so how much stock of carbon there is and the expected temperature increase. And what you see is a remarkably linear relationship. That's important because it means that if we want to target 1.5, let's say, degree, which has been one of the big targets, well, that tells us how much stock of carbon in the air, right, is going to cause that. And that's, roughly speaking, about 3,000 gigatons of CO2. What's a little scary is we're not too far away from there. I mean, we're at 300, where the remaining carbon budget, if you will, is about 300 gigatons of carbon CO2. That's not much, meaning we're actually quite close to the 1.5 target. What's also scary is if we look at the second chart, and this is showing us over time the evolution of the annual carbon emissions per year in gigatons, where right now, at least in 2019, before the pandemic, we were at about 35. Again, we have a carbon budget of about 300 left, and we're using it about 10% per year. That means that in about 5 to 10 years, if we continue at this pace, well, we're going to meet this target and maybe more, right? Now, 2020, we had the pandemic, right? So the pandemic, well, we stopped traveling, we were confined, so that should reduce, right, the overall carbon emissions, and it did. But not by much, by about 5%, 5-6%. And then, well, we're all back. Now after the post-pandemic recovery, well, we're back to where we were at about 35 gigatons of CO2 out there, so we're exhausting our budget. And what's scary is if we really need to go to net zero and have the 1.5 degree targets, that's the slope at which we need to decrease our emissions year after year. Right? So the carbon decrease during COVID was about 6%. We need to do 8% per year, every single year from now to 2050. That's what it means. No, that to me is a scary thought, given the fact that we're still quite dependent on our current lifestyle.
Where are we on our goal setting? And as you mentioned, sort of the international goal is the Paris Agreement. So we have the 1.5 goal. And from that 1.5 goal, countries have a role, and countries have set their nationally determined contributions, so they've set goals at the national level. And then third, we've got corporations, asset owners, asset managers, banks, public financial institutions that are setting goals. We've got the GFANZ, the Glasgow Financial Alliance for Net Zero, an association of a number of private sector actors that have come together. So they're setting goals. And then individuals, all of us, we can set goals. What are we going to do? How did we get here today? So there's goal setting on a number of different levels. After we look at the goal setting, then we need information. We need information. How are we actually going to achieve those goals? What are the pathways to decarbonization? So we need a lot of information. The third piece is incentives. And where are we on incentives? We need both sticks and carrots, right? We need sticks to make action, and we need incentives to sort of impel action, if you will. So a long way to go, but I'm optimistic that we can affect change.
The momentum in terms of setting goals and setting targets really picked up over the last 2 years, leading up to COP26, and it was tremendous, the amount of like you said, target setting, goal setting that we've seen. We have about 85% of emissions right now are covered by countries that have set net zero ambitions. About a third of publicly traded companies have set net zero emissions targets. Of course, net zero by 2050, that's in a long time. So there's quite a bit of work to do in the near future, but a lot more focus on it now from all levels, from the public side, from the private side, which for me is really, really great to see. And I am an optimist as well. I do believe that when people come together for a common goal, that there's a lot that we can achieve.
So let's talk about actions. Banks play a critical role in the ecosystem as capital providers, both to traditional industries, to renewable energy, green industries. In your view, could you elaborate, and I'll start with you, Fanny, the role of private banks in this transition to net zero?
It's a very unique role that banks play in this transition. As you know, Scotiabank is a major global bank with operations across many countries and multiple continents, yet our emissions footprint from our own operations are actually quite small. Come from when you think about scope 1, scope 2, and scope 3 emissions, most of our emissions fall into that scope 3 category, where it's the emissions of the products that we offer. The products that we offer is financing, so our financed emissions. That is where a lot of our emissions come from, and that puts us in a really unique position where, you know, there's great things we can do with our own operations, but we really have to work with our clients to help them through the transition.
When we look at a public bank as opposed to a private bank, you don't have the same number of depositors, you have one big client, the government in a way. What is the role of a public bank in relation to private banks in the transition?
We're supporting private investments only in emerging markets, so we don't work domestically in Canada or in developed markets. We support investment, both domestic investment, mobilizing international investment into emerging markets and developing economies. So in that way, we're a capital provider. We provide both debt products as well as equity products. But we are net negative, and that's something that we wish to keep up. We have a number of forestry investments that have allowed us to do that. We don't finance oil and gas. And so that is something that's part of our corporate culture, part of our values, and something that we're very, very proud of, and that we're going to continue doing that going forward. We have a very much a client-centric approach, as Fanny was saying as well. We're working with our clients, again, these are clients in emerging markets, to help them make good decisions and direct our financing to perhaps, green outcomes as well. So
everyone has to work together, including the public and private sector, and blended finance is a fantastic example of that. As a private bank, we still, and you guys both have mentioned it, we still have to operate within our typical and required risk and return framework. That is what we do. And there are a lot, especially on the infrastructure side, especially in emerging markets, there are a lot of projects that are really important, really needed, but might have too much risk or not enough return for private sector money, not just private banks, but just for private sector to be able to come in.
Trying to figure out how to mobilize private capital at scale by using blended finance is also something that we're very much working on. And so just to give an example how blended finance can be used at the transaction level, but it can also be used at the platform level. And FinDev Canada is working with a Canadian pension fund and a global bank on structuring a blended finance platform that will bring in some concessional finance in a first loss position to again address that risk return, the risk return appetite of the private sector, and those use of proceeds will be used for subnational infrastructure projects. So again, it's to support infrastructure, but it's a $1.2 billion platform, so it's mobilizing capital at scale into infrastructure.
And on that platform, what are the best practices, if you will, that allow you to achieve that scale and allow investors to go in without necessarily looking at deal by deal?
I think the first thing is to find a good partner, and I've worked on a number of different platforms over my career, but I think that what makes this particular platform different that we're working on is the fact that we've found that partner, and we're really rolling up our sleeves together. They're committed, we're committed, and we've got really excellent communication. And FinDev Canada, so we're, as I've said, we're a development finance institution, and part of what we bring to the table is that broader sustainability framework. We're an investor and a financier that looks through a development lens, and we have 3 impact goals that we hold high in every investment we make. One is gender equality and women's economic empowerment. The second one is market development, and the third one is climate action. So not only are we looking at climate action in that platform, we're looking at many of these other sort of sustainability type criteria, if you will. And
Scope 3 is the full set of emissions by the firm, but all the suppliers and upstream, downstream on the supply chain. This one is capturing everything, but it's a lot harder to measure, right? And outside the firm's direct control. If we take those corporate net zero pledges, what are best practices in your view for particular firms of how they should set their net zero pledges given the wide set of metrics and scopes that are at play?
In general, how we would approach it is you can't manage what you can't measure. You can't manage what you don't measure, right? And so the idea of going back to what I said earlier in terms of is there information out there? What are the decarbonization pathways? But setting that baseline and really understanding, going back to your graphics, where do I fit, and how does everything I do, what types of emissions and when and how are those emissions created across my supply chain. So I think the idea of setting the baseline and really understanding what you're measuring and how to measuring is really kind of that first step.
So you have to set a baseline. What is going to be your baseline year that you're going to measure progress against? So typically that's the last year that you can have data for. Typically we also recommend having historical data before that baseline year. So again, you can measure a trend line so you can get some information from that. Definitely best practice for companies to have science-based emissions reduction targets. Again, because we're trying to limit global warming to 1.5 degrees. For Scotiabank, in terms of our Scope 1, Scope 2, Scope 3 footprint, a lot of our emissions are in Scope 3. So for us, it's important to have net zero and to have emissions reduction targets that include our Scope 3, which we just announced our first targets earlier this year.
So what I find interesting what you're saying, it's very much of a pragmatist view on on the situation where there's no such thing as setting a scope 1 or a scope 3 across the boards. It's let's work with what the companies can achieve, their capacity to build a process, what they can measure, and build step by step so that we can have the right metric given where they are right now and what they can achieve.
Yeah, and what makes sense for their business
And what
too.
makes sense for the business.
Where can they have the biggest impact should be the focus, at least for now. I do think over time we'll start seeing more and more absolute emissions reduction targets. Again, at this point, people are still more comfortable with that intensity. I think another key point about intensity, why we see a lot of corporates do it that way, is it reduces volatility based on size. So if you have companies that are acquisitive, that's going to have a big impact on your absolute emissions. Perhaps in 1 year you become twice as big. But you could be buying a company that is really efficient or really good and will transform the other part of your business. So again, it's about the information that you get from the two metrics are quite different.
What about the investors' net zero pledges? Should we view them in the same way as the corporate net zero pledges? Investors own a portfolio of stocks. There might be some double counting once you start thinking in terms of scope 3.
A couple of big differences are, one is the data front. When you go out to, from a bank perspective, from an investor perspective, from a pension, you have to have the data for every single company that you're financing or investing in. You don't know if your data is good, you don't know if it's bad, so it makes it a lot harder to make decisions when you can't fully trust the data because it's not necessarily your own and you don't have perfect information. So I think that's one big challenge for financial institutions versus corporates. And then another big difference is your levers are quite different. And levers meaning how can you reduce emissions? That decision-making process is very different.
What about you, Lori? You were mentioning earlier that you are net negative as opposed to net zero per se. Is there a target on the net negativeness, or is that...
Well, that's a benefit because we've made some forestry investments.
Yeah.
So it's something that, again, we're really proud of. But going back to sort of the challenges, I think you Fanny, you said it very, very well in that it's for financial institutions, and it's really about that influence and how, going back to the theme of collaboration, how can we work with clients to help them put together credible decarbonization pathways to help them with some of the data issues that they may have.
So let's talk more about collaboration, and let's talk now about the actions. Let's meet those targets. And as you said, Fanny, in the next few years, we should expect more discussion about the actions and getting the targets.
We've actually been seeing a lot of collaboration between different types of companies across the supply chain to help each other. One, because they need to, because the world needs it, but also because they need to reduce their scope 3 emissions, because like I spoke about earlier, you don't own your scope 3 emissions. So you really have to influence others, your clients, or across your supply chain in order to get that reduction.
And we're talking about, the two parts of the supply chain talking to each other and trying to find innovative ways to partner. Shareholders are requiring that as well in certain circumstances. But also, don't forget the power of the people, right? Like, if at the end of the day, the consumers, if that's what the consumers want, I mean, you vote with your feet, you vote with your wallet. So whether it's a national government, a provincial government, a state government, a city government, governments are the ones that are generally responsible for deciding, hey, we need more renewable energy on the renewable energy on the grid, as opposed to other forms. We need more public transportation. And so government, even if they want the private sector to build, own, operate, finance, and invest in those projects, so the governments actually have a really huge responsibility in, again, raising the bar and setting those sustainability standards.
If you were to play around with a $100 billion fund, what would, for getting us to net zero, what would be your thought process about how to spend it, and how would you allocate it so that we can most effectively get to net zero in due time.
But I think a lot of where we need to invest in is on innovation and on new technologies that will help us with the energy transition. The problem with a lot of this is a lot of the technologies as of yet unproven, so it can be risky. Another one, and sorry, there's so many of them, is I think, Lori, some of the work that you're doing in emerging markets, I don't think there's been enough money flowing to emerging markets, and they certainly need the support of economies like Canada, the US, and Europe to transition. We have to think about a just transition, and that emissions are global. And so more money in emerging markets. And the last one, I promise, that I'll talk about for my free $100 billion is one we've actually been spending a lot of time on this, is improving the transmission infrastructure. There's so much focus on renewable energy and the generation side, but we need the transmission to bring the power from those sites to people's homes, to businesses.
If I were to complement all the things that Fanny were to invest in, I would go to coal transition to get countries off coal. A lot of the big emitters, South Africa, Indonesia, et cetera, the just energy transition partnerships, I would put money there, get them off coal. I'd dump a lot of money into R&D, particularly in the hard to abate sectors, so steel, cement, glass, et cetera. Hydrogen, I mean, a lot more R&D money needs to be brought to the fore. And then probably the third area would be around land use.
Thank you. This has been super insightful.